Every year, millions of Americans hand their life savings to a financial advisor. They trust that the person sitting across the desk from them, the person with the certificates on the wall and the professional title on the business card, is legally and ethically required to act in their best interest. Most of them are wrong. And the difference between choosing the right financial advisor and the wrong one is not just a few $100s in fees. It is the difference between a comfortable retirement and spending your final years wondering what happened to the money you worked 40 years to build. Here is something the financial services industry does not advertise. In the United States, the majority of financial professionals who call themselves financial advisors are not legally required to put your interests ahead of their own. They operate under what is called a suitability standard, meaning they only need to recommend products that are suitable for you, not the best products for you. The distinction matters enormously. A suitable product might earn your advisor a $5,000 commission. The best product for you might earn them nothing. Under the suitability standard, they are legally permitted to choose the first option every single time. In this video, I am going to give you the complete framework for choosing a financial advisor without getting ripped off. The specific questions to ask before you hire anyone, the credentials that actually mean something, and the ones that are essentially meaningless, the fee structures to look for, and the ones to run from, the specific red flags that tell you to walk out of the meeting immediately, and the type of advisor, a very specific type, who is legally required to act in your best interest at all times. By the end of this video, you will know more about choosing a financial advisor than 95% of the Americans who currently have one. Stay until the fourth section of this video, because that is where I give you the exact word-for-word questions to ask any financial advisor before you give them one. Dollar of your money. These questions asked directly will reveal everything you need to know about whether the person sitting across from you is there to build your wealth or theirs. Most financial advisors will not enjoy being asked these questions. The ones who answer them clearly and honestly are the ones worth considering. Let us get into it. How to choose a financial advisor and never get ripped off. The first thing every American needs to understand about the financial advisory industry is that the title financial advisor is not regulated. In America, almost anyone can call themselves a financial advisor. There are over 300,000 people in the United States who use this title in some form. Some are brilliant, ethical professionals with decades of experience who have dedicated their careers to genuinely improving their clients' financial lives. Others are essentially commissioned salespeople who have completed a minimum licensing requirement and are primarily motivated by the products they sell. Understanding the difference and knowing how to identify which type you are talking to is the entire purpose of this video. The single most important concept in choosing a financial advisor is the fiduciary standard. A fiduciary is legally required, not just ethically encouraged, to act in their client's best interest at all times. This means they must recommend the products and strategies that are genuinely best for you, even if those recommendations produce less compensation for the advisor. They must disclose all conflicts of interest. They must prioritize your financial outcome above their own. In America, not all financial advisors are fiduciary, but the ones who are, specifically registered investment advisors and certified financial planners who have signed a fiduciary oath, provide a fundamentally different level of protection for your money. There are two primary categories of financial professionals in America, and the legal obligations they operate under are fundamentally different. Broker-dealers who work for firms like Merrill Lynch, Edward Jones, and most major banks operate under the suitability standard. They are permitted to recommend any product that is suitable for your situation, even if a better option exists that pays them less. Registered investment advisors, RIAs, operate under the fiduciary standard. They are legally required to act in your best interest at all times. The SEC regulates RIAs with more than $100 million in assets under management. State securities regulators oversee smaller RIAs. When you are looking for a financial advisor, registered investment advisor is the legal designation that guarantees fiduciary protection. Commission-based financial advisors earn money when they sell you a product. A whole life insurance policy might earn them a commission of 50% to 100% of your first year premium. An annuity might pay 5% to 8% of the amount you invest. A specific mutual fund might pay ongoing trailing commissions called 12 billion minus 1 fees every year for as long as you hold it. These commission structures are not illegal. They are disclosed somewhere in the documents you sign, but they create a powerful financial incentive for the advisor to recommend the highest commission product rather than the best product. And research consistently shows that commission-based advice costs Americans significantly more in both fees and suboptimal product selection than fee-only advice over time. There are 3 fundamental advisor compensation models, and knowing which one you are dealing with tells you an enormous amount about the incentives driving their recommendations. Fee-only advisors charge you directly either as a percentage of assets managed, a flat annual retainer, or an hourly rate, and receive 0 commissions from any product they recommend. Fee-based advisors charge a fee, but also receive some commissions, creating a partial conflict of interest that requires careful management. Commission-only advisors earn exclusively through product sales, with the highest conflict of interest of any model. For Americans who want genuinely objective financial advice, fee-only fiduciary advisors are the gold standard. Period. The financial services industry has created over 200 professional designations that financial advisors can display after their names. The vast majority of these designations require minimal education and can be obtained in a weekend. They are designed to create an appearance of expertise and credibility, not to guarantee it. As an American consumer navigating the financial advisory landscape, you need to know which credentials actually represent meaningful expertise and ethical obligation, and which ones are essentially decorative. There are 3 credentials that genuinely matter, and understanding what each one means will help you immediately identify advisors worth considering. The Certified Financial Planner, CFP, designation is the most widely recognized and respected credential for comprehensive financial planning in America. Earning the CFP requires completing an approved educational program covering all major areas of financial planning, passing a rigorous, comprehensive examination, accumulating 6,000 hours of relevant professional experience, agreeing to adhere to the CFP Board's Code of Ethics and Standards of Conduct, which includes a fiduciary obligation to clients, and completing ongoing, continuing education requirements. CFP professionals who have also registered as registered investment advisors provide the combination of planning, expertise, and fiduciary legal protection that most Americans need. The Chartered Financial Analyst, CFA, designation is considered the most rigorous investment credential in the world. Earning the CFA requires passing 3 levels of examinations, each requiring approximately 300 hours of preparation, covering portfolio management, equity analysis, fixed income, derivatives, and ethics. The CFA designation is primarily held by investment managers, portfolio managers, and analysts rather than personal financial planners. If you are looking for an advisor to manage a significant investment portfolio, a CFA holder brings exceptionally deep investment analysis expertise. CFAs are less common in personal financial planning than CFPs, but represent the highest standard of investment management knowledge available. Before hiring any financial advisor, verify their credentials and regulatory history using free government tools that every American can access in minutes. For broker dialers, go to BrokerCheck at brokercheck.finra.org. This database shows the advisor's registration status, employment history, and most importantly, any regulatory actions, customer complaints, or disciplinary events in their history. For registered investment advisors, use the SEC Investment Advisor Public Disclosure Database at advisorinfo.sec.gov. And for CFP holders, verify the designation at cfp.net. These checks take 5 minutes. They are free, and they have the potential to save Americans from advisors with histories of complaints and disciplinary actions that are publicly documented, but that consumers rarely think to look for. When you run a BrokerCheck or IAPD search on a potential advisor, here are the specific red flags that should cause you to immediately end the conversation. Multiple customer complaints, even if resolved in the advisor's favor, suggest a pattern of client dissatisfaction that warrants extreme caution. Regulatory sanctions or disciplinary actions from FINRA or state securities regulators, indicating that the advisor has been found to violate industry rules. Terminations for cause from previous employers, which are disclosed and represent serious professional misconduct. Personal bankruptcy filings, which raise legitimate questions about the advisor's own financial judgment. Any criminal charges, even if not resulting in conviction. An advisor managing hundreds of millions of dollars in client assets with multiple complaints and a regulatory sanction is not a safe choice, regardless of their credentials or the size of their firm. Here are the exact questions to ask every financial advisor before you hire them in order of importance. Question 1. Are you a fiduciary at all times for all services you provide to me? This is the most important question. The answer must be yes, unconditionally, not most of the time, not for some services, all times. Some advisors will say they act as a fiduciary when providing investment advice, but not when selling insurance products, because insurance product sales fall outside the fiduciary requirement. This partial fiduciary status creates exactly the conflict of interest you are trying to avoid. The answer must be yes, at all times, for all services, in writing. If the answer is anything other than a clear, unqualified yes, thank them for their time and leave. Question 2. How exactly are you compensated? Get a complete and specific answer. Do you charge a percentage of assets under management? If so, what percentage? Do you charge a flat annual retainer or hourly fee? Do you receive any commissions from products you recommend? Any trailing fees, 12 billion minus 1 fees, or referral fees from fund companies or insurance carriers? Any compensation from third parties for recommending their products or services? A transparent, fee-only advisor will be able to answer all of these questions clearly and specifically. An advisor who is vague, who deflects, who says they are compensated in ways that are complicated to explain, is telling you something important about their willingness to be fully transparent about how your money flows through their practice. Question 3. What is your investment philosophy? A trustworthy, knowledgeable advisor should be able to articulate their philosophy clearly and specifically. The answers that should give you confidence: low-cost diversified index funds as the core of most portfolios. Long-term perspective over market timing, asset allocation matched to your specific risk tolerance and timeline. Minimizing fees as a priority, since fees are the only certain drag on returns. The answers that should concern you: claims of ability to beat the market consistently. Proprietary investment strategies that are difficult to explain simply. Heavy emphasis on complex products like variable annuities or structured products. Frequent trading strategies that generate transaction costs. Research shows that investment approaches emphasizing simplicity and low costs outperform complex active strategies over virtually every long-term period in American market history. Question 4. What is my total all-in annual cost? This question is critical because advisor fees are often presented as a single number, but the true cost of working with an advisor involves multiple layers. The advisor's management fee, typically 0.5% to 1.5% of assets managed annually. The expense ratios of the underlying funds recommended, which can range from 0.03% for index funds to 1.5% or more for actively managed funds. Any platform or custodian fees. Any transaction costs from trading. The total of all these fees, your all-in annual cost, has an enormous impact on your long-term returns. A 1% advisor fee plus 1% in fund expenses equals 2% annual drag. On a $500,000 portfolio, that is $10,000 per year leaving your account. Over 20 years, the compounding effect of that fee difference can reduce your final portfolio value by $200,000 to $400,000. Question 5. Can you provide references from clients and situations similar to mine? And how many clients do you currently serve? A good financial advisor should be willing to connect you with current clients who can speak to the quality of their service. Be wary of advisors who cannot or will not provide references. Also ask about the advisor's current client load. An advisor managing 500 clients cannot provide the same level of attention as one managing 100. Ask how many clients they personally serve, not the total count of the firm, and what the typical frequency and depth of client communication looks like. You should expect at minimum an annual comprehensive review meeting and availability for consultations when significant financial events arise. Let me walk you through the main fee structures you will encounter, what each one costs in real dollars, and when each one makes sense for different Americans. The Assets Under Management Fee Model, or AUM, charges a percentage of the total assets the advisor manages for you annually. The industry standard is approximately 1% per year, though fees range from 0.25% to 1.5% depending on the advisor and the size of your account. On a $500,000 portfolio, to 1% AUM equals $5,000 per year. On a $1 million portfolio, $10,000 per year. The OAM model makes most sense for Americans who need ongoing investment management and comprehensive financial planning, and who have sufficient assets to justify the annual fee relative to the services provided. The flat fee and hourly fee models are often significantly better value for Americans who do not need ongoing investment management, but who do need specific financial planning advice. Flat fee advisors charge an annual retainer, typically $2,000 to $7,500 per year, for comprehensive financial planning services, including tax planning, retirement planning, insurance review, and estate planning advice. This is often far less than a 1% AUM fee on a large portfolio. Hourly fee advisors charge $200 to $400 per hour for specific consultations, ideal for Americans who need advice on a particular decision, like when to take Social Security, how to structure a pension payout, or whether to refinance their mortgage. NAPFA. The National Association of Personal Financial Advisors maintains a directory of fee-only fiduciary advisors across America that you can search by location and specialty. Here are the specific red flags that should cause you to immediately end any meeting with a financial advisor. The first and most serious, any promise of guaranteed investment returns above current risk-free rates. There are no guaranteed high returns in legitimate investing. Any advisor claiming otherwise is either lying or selling you something that will cost you dearly. Second, pressure to make an immediate decision. Legitimate financial advisors understand that significant financial decisions require time and consideration. Any advisor who creates urgency, who says an opportunity is only available today or this week, is using a sales technique that should disqualify them instantly. Third, an early request for discretionary authority over your accounts, the ability to make trades and move your money without your approval on each transaction. This authority should only be granted to advisors with an established relationship and a proven track record. Additional red flags that every American should watch for. An immediate recommendation of annuities or whole life insurance products at the very first meeting before the advisor has conducted a thorough analysis of your complete financial situation. These products carry high commissions and are frequently unsuitable for the situations in which they are sold. A recommendation portfolio consisting exclusively of the advisor's firm's proprietary products, which typically carry higher fees than equivalent third-party options. Unwillingness to confirm fiduciary status in writing. A legitimate fiduciary will have no objection to putting their commitment to act in your best interest in writing. And any advisor who cannot clearly and specifically explain how every product they recommend earns them compensation, that lack of transparency is incompatible with genuine fiduciary obligation. Before we get to the action plan, let me address a question that every American should ask honestly before spending money on a financial advisor. Do you actually need one? For Americans with relatively straightforward financial situations, a stable income, a 401k at work, a Roth IRA, and a simple investment strategy of low-cost index funds, the answer may be no. A 3-fund portfolio VTI for U.S. stocks, VX, US for international stocks, and B and D for bonds in an allocation appropriate for your age and risk tolerance can be managed entirely without an advisor at virtually zero cost beyond the minimal expense ratios of the funds. Robo-advisors like Vanguard Digital Advisor, Betterment, and Fidelity go provide automated portfolio management for fees well below 0.5% annually. For complex situations, estate planning, business ownership, complicated tax circumstances, significant wealth, a qualified fee-only fiduciary CFP provides value that far exceeds their cost. Here is your complete step-by-step process for finding and hiring a financial advisor without getting ripped off. Step 1. Honestly assess whether you need an advisor at all. If your financial situation is straightforward and you are comfortable managing index funds, consider a low-cost robo-advisor before paying for human advice. Step 2. If you decide you want a human advisor, start your search at NAPFA.org, the National Association of Personal Financial Advisors, which maintains a directory of fee-only fiduciary advisors searchable by location and specialty. The fee-only requirement is built into NAPFA membership, eliminating commission-based advisors from your search before it begins. Step 3. Before meeting with any advisor, run their name through BrokerCheck at brokercheck.finra.org and the SEC's IAPD database at advisorinfo.sec.gov. Look specifically for any customer complaints in the past 10 years, any regulatory sanctions, and any terminations for cause. A single serious complaint or regulatory action does not automatically disqualify an advisor. Context matters, but multiple complaints, sanctions, or terminations should eliminate any advisor from consideration immediately. Step 4. Interview at least 3 advisors before making a decision. Use the 5 questions from earlier in this video at every interview. Pay close attention not just to the answers, but to how the advisor responds to being questioned. A trustworthy professional will welcome your due diligence. A salesperson will try to redirect or minimize it. Step 5. Before signing any advisory agreement, request and review the advisor's Form ADIF Part 2. This is a disclosure document that all registered investment advisors are required to file with the SEC, and it contains detailed information about the advisor's services, fees, conflicts of interest, disciplinary history, and business practices. Read it carefully. Pay particular attention to the conflicts of interest section, which should clearly identify any ways the advisor's compensation could create incentives that differ from your interests. If conflicts exist, they should be clearly disclosed and explained. Request written confirmation of the advisor's fiduciary commitment. Request a complete written fee schedule covering all potential charges, and never sign any agreement or transfer any money until you have received and understood both documents. Here is the honest bottom line about financial advisors in America. The right advisor, a qualified fee-only fiduciary CFP with a clean regulatory record, transparent fees, and a sound low-cost investment philosophy can add genuine value to your financial life that far exceeds their cost. They can save you from behavioral mistakes that cost far more than any advisory fee. They can optimize your tax situation, coordinate your estate plan, and ensure your insurance coverage is appropriate. But the wrong advisor, a commission-driven salesperson operating under the suitability standard, pushing hi-fi products with undisclosed conflicts of interest, can quietly cost you hundreds of thousands of dollars over a career. The difference between them is not always immediately obvious, but the framework in this video, the questions, the credentials, the verification steps, the red flags will help you find one and identify the other every time. Let us bring it all together. How to choose a financial advisor without getting ripped off. The fiduciary standard is your most important protection. Only work with advisors who confirm fiduciary status at all times and in writing. Fee-only advisors with zero product commissions provide the most objective advice available. The CFP and CFA designations represent genuine expertise. Verify them and verify the advisor's regulatory history on BrokerCheck and the SEC IAPD database before meeting anyone. Ask the 5 critical questions: fiduciary status, compensation structure, investment philosophy, total all-in fees, and references. Watch for the specific red flags: guaranteed returns, urgency tactics, immediate annuity pushes, and resistance to transparency. Review the Form ADV Part 2 before signing anything. Here is my challenge to every American watching this video. If you currently have a financial advisor, today ask them one question: are you a fiduciary at all times for all services you provide to me? If the answer is anything other than a clear and unqualified yes, you now know exactly what that means. And you know exactly what to do. Drop a comment below and tell me, do you have a financial advisor right now? And do you know whether they are a fiduciary? I read every single comment and will personally reply. Every good financial decision you make today, your future self will thank you for. The best time to start was yesterday. The second best time is right now.